Hello friend, welcome to the second chapter of our online course for profiting in Toronto condo market. Now that you have a deeper understanding of how to find the best locations and how to look for the upside, we're going to move on to pricing. Yes, the money side of things when we're evaluating our investment opportunities. Let me start off with a little bit of background information for you. You often see these three letters being used in the pre-construction world, PSF. It stands for price per square foot. It is very important that you understand this concept, as price per square foot, or PSF, is the common denominator in which we measure the price of a project and condo. Remember, it's hard to compare the price of a condo to another when you have one bedrooms plus den, 2 bedrooms, and even sometimes 3 bedrooms now. The analogy I like to use is price per square foot is the equivalent of the US dollar. In the world when we trade commodities, everything is measured in USD, such as the price of a barrel of oil. Although it can cost X in Canadian dollars and Y in euros, we always convert it back to USD, similar to price per square foot. We always convert the cost of a condo into price per square foot. Let me illustrate this for you. To be near a subway station in the downtown core, it's approximately $1,400 a foot. Yes, we got there a while ago. So this means your average one bedroom is approximately 450 square feet. This means the total price of your condo is $1,400 a foot times 450 square feet, which means it's about $630,000. When you go outside of the premium areas, the price per square foot will drop. When we buy in premium locations, such as the example above, we pay for the premium in price per square foot. When we buy in the areas that have potential to grow, we're paying for a lower price per square foot and are investing with the potential of upside. In order to make money in the premium locations, the price per square foot has to increase, which means the demand for that area must increase, which honestly happens quite often in Toronto, especially if you're near a subway station. Most people tend to feel safer to invest in these premium areas because of that demand. However, not everyone can afford the premium price per square foot. That is why it is worth looking into locations with upside that have a lower price per square foot. You just need the price per square foot to catch up to market to make money. Now that we understand the price per square foot concept, how do we determine if a project is investment worthy? From a financial perspective, we always want to look at two things. First, we want to look at what the current price per square foot in the resale market around the project is. If we're under, that's a slam dunk. Buy now, think later. If we're on par, that is still a great opportunity because when your investment finishes, it'll be the newest and best one on the block, which commands the highest price per square foot, not to mention the appreciation you'll gain over the build time. The second financial perspective we look at is cash flow, which by the way is the first principle of real estate investing. Let me give you a quick background on what cash flow is from a real estate investor's perspective. Cash flow is the total money you put in your pocket or pay out of your pocket after collecting rent and paying expenses such as mortgage, property taxes, property insurance, and condo fees. Let me illustrate this with an example for you. The average rental rate of a one bedroom right now in the downtown core is about $2,400 a month. So your cash flow in your pocket is $2,400, and then you need to make your monthly mortgage payment for about $1,800 a month, and then your property taxes for $150 a month, then your insurance for $50, and your condo fees for $300 a month. And at the end of the month, you're left with $100 extra in your pocket. That is your positive cash flow. So what we want to do is find out what the current rental rate for the condo we're evaluating is and see if we can make it positive cash flow. If it cash flows positive with the current market rental rate, you're golden. However, very rarely will you be able to make it cash flow positive on the current market rate. So then you may ask, Zhen, what on earth are you talking about? Why are we buying pre-construction instead of resale when we are investing? Well, let me explain. It's incredibly difficult to find any condo that will cash flow on the resale market at the current market rates. It is like trying to find a unicorn. If you can find one, buy now, think later. If it was that easy, everyone would be doing it. This is why we buy pre-construction. The opportunity to cash flow is much higher in pre-construction, and instead of finding a unicorn, we're looking for zebras. We know where to find those in Toronto. When the project completes and we incorporate our location and upside in the area, the new rents when we get keys will make our investment cash flow positive. Projects my clients are getting keys to now with their mortgage based on the prices they paid 5 years ago are all cash flow positive. Quite nicely, I will add. The other two principles of investing are mortgage paydown and appreciation. Mortgage paydown is when your tenant's rent helps contribute to increasing your equity. Let me repeat that for you. It is when your tenant's rent helps contribute to increasing your equity. Or in layman's terms, that is when your tenant is helping you own more of your property than the bank does. Remember, you own some of the equity in the property and the rest of the equity belongs to the bank until you are mortgage free. Each month, as your tenants pay your rent, they help pay down your mortgage and you gain equity. This, my friends, is actually the principal wealth generator in real estate. And please keep that in mind. Your tenants paying for your property. And that is why we are in the real estate game. It is because owning the asset is the real wealth generator. The last principle of investing is what everyone talks about. That is appreciation. Appreciation is what happens when an area grows and gets more expensive. When we look at the locations with upside, we are looking for locations that have the ability to appreciate in value. I like to say that we don't buy real estate for appreciation because we never know what can happen. We can only do our best to find the upside. Toronto condos have been appreciating quite nicely in the last decade and didn't see a drop-off during the so-called crash of mid-2017. On average, the appreciation rate for condos in the last 10 years has been slightly over 8% per year. But of course, when you buy, don't bank on that. I'm very conservative, and when I do my numbers, I like to use half of that, so I use 4%. When analyzing your numbers and going through the fundamentals of real estate investing, you can think of it as a 3-course meal. Cash flow is the appetizer. It won't make you full or rich, but it's definitely nice to have. Mortgage paydown is the entree. It's what you came for, and it'll make you full and wealthy. And finally, appreciation is like dessert. It's a bonus, nice to have, but you don't want to bank on appreciation to make you money in real estate. That is what we call gambling. Now that you know how to look at the investment opportunities like a pro, feel free to pause here for a little break or a breather because we're going to continue talking more about monies. When we're buying pre-construction, the amount of monies we need differs from resale as well. Oftentimes, you'll see deposit structures that look like this: $5,000 on signing, balance of the 5% in 30 days, 5% in 90 days, 5% in 270 days, and 5% on occupancy, or when we get keys. I'm going to break this down for you into nice and digestible tidbits. Once you have secured a unit, you will need to write 4 post-dated checks to the developer. On signing your documents for buying the unit, you will hand over your $5,000 check, which they will only cash after the 10-day cooling period, but more on that later in the course. Then in 30 days, they will cash the balance of your first 5%. Then in 90 days or 3 months, they will cash the next 5%. Then in 270 days or 9 months, they will cash the next 5%. And finally, the last 5% is when you get keys on occupancy. So, if you're buying a $500,000 condo, the breakdown looks something like this. Signing, $5,000. 30 days, $20,000. 90 days, $25,000. 270 days, $25,000. Occupancy, when we get keys, the last $25,000. It's pretty awesome because you start to reap the benefits of appreciation in the area once you buy. But you don't have to come up with the 20% to buy as you do have to with the resale. On closing, when you become the proud owner of your new condo, the deposit will likely become your down payment for the bank to start your mortgage. Bear with me, guys. I know this video is a bit longer than the first, but it's because we're talking about money, and everyone wants to be crystal clear when we're talking about making monies. The last thing we will talk about is maintenance fees. When you buy a new condo, you'll often see an estimated maintenance fee in the form of dollar per square foot, similar to the dollar per square foot in the earlier part of the video when we're talking about pricing. We want to take their estimate of the maintenance fees and multiply it by the square footage of the unit we're buying to get a monthly estimated maintenance fee. This rate is often locked in for the first year or two. Remember, buildings with fewer amenities such as outdoor pools will have lower maintenance fees, which means more money in your pocket. Another thing to remember is that the maintenance fees that are projected doesn't include inflation, like the ones in resale, which means in comparison to the current market rate maintenance fees, it is likely lower when you get keys. That is exactly why we buy new, so we can reap the rewards of low maintenance fees as well. Remember, it's buy low, sell high. Well, that wraps up Chapter 2 on monies. I hope you followed along and are able to understand how to look at investment opportunities from the financial perspective. When you combine the concepts and knowledge you have just learned in Lesson 1 and 2, I'd probably say you're smarter than 75% of the current condo investors out there right now. So hats off to you. The next step is to obviously take action. But before you do, make sure you watch the last 2 videos in this course that'll make you a pro. Stay tuned and I'll see you in the next one. Well, I hope that animated version of how to profit from the condo market is very helpful to you and creates enough information and excitement for you to invest in downtown Toronto and the condo market. If you are looking for my pre-construction cheat sheet, which is how I take you from start to finish, meaning finding the correct project to filling in a tenant, I'll put the cheat sheet in the description below. All you have to do is enter your name and email and I'll send it to you, okay? Until next time, happy real estating. Make sure you get that document, it's really good.